Welcome everybody to the second episode of the Shay Sharma Show. Today I'm honored to have a long-term partner in crime, somebody I've been working with over the years, a business associate, a friend, somebody I rely on heavily for my personal and professional mortgage needs. I have Mr. Mohit Masand. Welcome, buddy.
Thank you, Shay. How have you been?
I have been great. And how many deals has it been? Like 50, 100? I've lost count. We've done so much together.
I'm pretty sure.
Right?
Yeah.
So, how's life? How's business?
Business has been nice. It's been up and down, like it's been for everybody, I guess.
Yep.
2023 and 2024 has been funny. But God's been kind, so it's not that bad.
Great, great. And, for people and in the audience who don't know you yet, give me like a comic book story of who Mohit Masand is, where you from, what's your education background, what do you do now, how did it all come about, and so on.
Sure. So I have been doing mortgages for about 7 years, but if we track back, I'm originally from India and I moved to Canada in about 2013 as a student. And the first job that I got after I completed my studies was selling photocopiers.
Oh, okay.
And I was doing what a lot of people are scared of doing, was door knocking.
Oh, boy.
And I was brand new into the country, so I don't even know if it's legal. I'm knocking on doors, and I was like, are they going to call the cops on me?
Yeah.
And especially when you go into these buildings that say no soliciting,
Yeah.
I'd still walk in. I had to get my sales. Commission only, right? That's how we start.
Right.
So I did that for a few years, that then got into sales analysis.
Right.
But eventually I thought, why not start something on my own? I've got the sales skill. I love doing marketing. I have a finance background. My brother was doing mortgages at that time, and he was like, why don't you try your hand at this? And that's how I got into mortgages. I guess some of the best things that happen to you are the ones that you do instantly. You don't think too much about. So I was, I was in this job. I was pretty stable doing sales analysis, and we were pregnant with our first child. We were expecting in August of 2017. May of 2017 is when I was like, I don't like this job anymore.
Great timing.
Yeah. I was told a few things which weren't exactly something I liked. And I was like, this is my moment. So within half an hour, here's my resignation, my 2 weeks of notice. And I got my mortgage license in May of 2017. So I started just a couple of months before my son was born. So the good thing about that was I got to spend a lot of time with my wife and my son. The bad thing about that was that finances were very tight at that time. You're just starting up. But I guess it was one of the best decisions I made for myself, because when you start and you are in that hard position, that's when you are willing to hustle and you're willing to do what it takes to be successful. If I would have started when I was very comfortable, I would perhaps have not done the hustle that I did in 2017, 18, 19. Knocking on hundreds of doors every day and, meeting with real estate partners, etc. But God's been kind and things have come up since. I think 2020, 2021 was really when I found my footing in the industry. The funny part is 2020 is when I switched my brokerages in June 2020. And I did fairly well, and I was expecting the Rookie of the Year award, and they said you couldn't get it because it's just half a year. You've not been here for the full year. It's like, great. 2021 comes around, pretty good year, and I'm going to the award function. They've not even nominated me for the Rookie of the Year award, and I'm so disappointed. Waiting there, chatting with my wife, she couldn't make it. And I'm telling her, I was expecting the Rookie of the Year. The next thing I know, I'm nominated for the Top Performer of the Year, and I win it.
Here you go.
And I think that was one of the best feelings because one, I was not expecting it. I wanted to be the rookie.
18 months in the brokerage, right?
In the new brokerage, exactly.
That's great.
And I have been the top performer since. So I won that in 2022 as well. 23, I started my own team, and my team was the top performing team at the brokerage as well. So things have been well since. I've closed about 200 deals in about 7 years. We've done quite a few together.
Yes, sir.
So thanks to you.
Thanks to you.
And partners like yourself, I think it's been a good ride.
Great. And I think from the story, I can relate to a couple of things. And I'm sure your son brought you a lot of luck.
Of course.
And he said, okay, Dad, I don't like what you do right now. So please do something else.
Absolutely.
And it's turned out great. And
100%.
that makes for a great story, I'm sure. and he'll probably understand it once he grows up, and you talk about life and business.
Correct.
And I think what's also great that you've always been in the sales industry.
Yeah.
And I think sales in any way, shape, or form helps.
Correct.
Like even when you're door knocking, irrespective of what you're selling, or at the time as you were selling photocopiers, it's still a place where you have to muster the courage to kind of talk to people, present yourself, have your best foot forward every moment in time.
Absolutely.
And I think that experience takes you a long way, irrespective of what you're selling, what industry you're from.
Absolutely.
And I think that's one thing in common in the both of us, because like I've been designing aircraft, selling, essentially body shopping in a way where I've sold, manpower and other, companies in that domain, and then I've been selling financial services and now real estate for the last many years. So I think what you and I have in common, and I think anybody who has a long-term sales experience, I think it always comes in handy.
100%.
In some way.
100%. And I think what resonated with me, and it's funny as well, you're talking about how there is a good story for me to tell my son. And it's become a broken record. Because you know how when we were younger growing up in India, our parents would always tell us about how they'd walk to school and they didn't have buses and they'd swim across ponds. I think I have that story, and I would have told my son numerous times. Every time he wants to buy something, and I'd be like, do you know when you were born? I would buy you stuff from my line of credit. So you got to respect money. And he's so sick of it. He's like, Dad, I got it. Don't buy me the toy. I'm fine.
Yeah, and you got to understand how line of credit works.
Exactly. He's going to be strong financially, I'm pretty sure, because I tell him quite a bit about how finances work. I take him to my office as well. In fact, he was there today. So I take him with me. He gets bored most of the times. He's like, I want to go to my mom's office. My wife works at a community college and they've got tons of stuff for family as well as compared to my office, which is fairly boring.
Fairly bland,
so, but he learns quite a bit when he comes, I guess.
Nice. And I know we can go on and on, but let's keep some of the conversation for the drinks for
100%.
later. So the vision I personally have for this episode is, whosoever is listening or, watching on YouTube, I want them to walk away with everything about mortgages. I know we can't cover everything, but what I mean to say is everything related to how mortgages work in Canada, the processes, the sequence of events, the down payment, and everything that we can perhaps give them, irrespective of where they are in terms of their journey. These people could be new to Canada. These people could have been here for a couple of years, but still they're just entering into the industry. It could be people with stable white-collar jobs, or people like you and me, people with small businesses, or people on contractual roles. I want to kind of cover like a broad spectrum of things in terms of bringing value today. Now I'll start off with a couple things. Now, when we talk to people sometimes, and I'm sure you've experienced that yourself, a lot of people, not everyone, but still a large percentage of people who are getting into the industry or making their very first move in real estate can't tell their head from their ass. Like they really can't, right? And I think that's when it becomes our responsibility to make them aware of everything that we can that is relevant for them in their situation. As I said, it could be everything. Down payment, processes, sequence of events, costs, whatever.
True.
And the best, or the worst thing rather, I see people doing right at the start of the process is that they just walk into their bank because that's what they know, right? When it comes to mortgage, they know the banks can deliver a mortgage. So they walk into their bank, they talk to their financial advisor or the mortgage advisor, and they believe and think that they're getting the best solution. You and I both know that's incorrect.
Correct.
And I'll just give my perspective, and you're the expert, so I'll pass it on to you. But what happens when you walk into the green bank? They offer you their own products. And what happens when you walk into the red bank or the blue bank and so on? People offer their own products because obviously they're incentivized to do that.
Correct.
However, I always tell people to go to a mortgage broker, a highly experienced mortgage broker, because those are the people who will take the time and the effort to understand your personal and financial situation.
Right.
And then recommend the best product that suits your needs.
Perfect.
Right?
True.
So talk about that a little bit more, and some of the other mistakes that you perhaps see, maybe first-time buyers or even otherwise, people make when it comes to mortgages.
Right. So let's first talk about the bank versus broker discussion. Uh, I know it's very common for, especially first-time home buyers, to just walk into the bank. And I think there's a legacy to it. We've been doing that for a while in Canada, believing that that's what we're supposed to do.
Right.
But things have changed significantly over a period of time. There are more sophisticated products available, not just with the banks, but with lenders that are not accessible to the banks. So non-banking institutions and credit unions and trust companies. And there's no harm in getting a mortgage from them. They have as good products, sometimes even better for your needs. But there are a few reasons why I tell people to consult a mortgage broker, call them an agent. People use that interchangeably. Is when you go to a bank, they could only offer the products that they have with them, like you just mentioned, which could be 4 or 5 products. When you walk into a mortgage agent's office or a mortgage broker's office, they have access to over 100 lenders. And if they are good enough, I'm not saying every mortgage broker could do it, but if they're good enough and they know their stuff, they'd then be able to structure the solution for you with the right lender. So that's the first thing. The second thing is, we are going in with the assumption that you're going to be approved at the bank that you walked into. But let's say this is your bank, people call it my bank, I'm going to walk in there. I've heard this a lot of the time saying, oh, my money gets deposited there, they have all my records. Doesn't matter. Your money gets deposited there means nothing. They still need your employment letter and your pay stub and your T4 and your down payment. They want to see everything. Yes, maybe it's easy if the down payment's there, they could pull the report themselves, the bank statements. But they still need to see documents like anybody else. But if they couldn't approve you, one, that means that they pulled your credit, it's gone to waste, you move to another bank, so you get your credit pulled again, multiple times perhaps. Second, it's inconvenience. You're going from one bank to the other. It's a lot of time. And we are living in a fast-paced world where no one has the time. When you talk to someone like a mortgage agent, I'm a salesperson, so I'll say someone like myself, is we talk to you once and there we go. This is what it is. In my mind, to be honest with you, Shay, when someone talks to me for the first time, and I think you would have seen that with your clients as well, within the first half an hour, I think I know which bank am I going to send their deal to. Because I know exactly where would this deal fit and what would be the right solution. And it's not just about the rate. It's about, oh, they need more prepayment. Maybe this bank's giving more prepayment over the other. Or this bank has a slightly better solution for 25-year amortization. And things like those. So that's another difference. But one difference that doesn't get talked about very often. A lot of the people know this difference, saying, okay, one credit pull, send it to multiple lenders, agent could do all that. But this is one distinction that I like to highlight. And this is just my assumption. When you walk into a bank, a lot of the people would be walking into a bank, is there someone who can help me with my mortgage? And they'd assign you to a personal banker, financial advisor, etc. That person, when you walk in, can sell you a credit card, can open a line of credit for you, can open a bank account for you, and can also do a mortgage for you. Whereas when you come to someone like me, this is what brings dinner to my table. This is what I do for a living, day in and day out. And what that also does is there's a much higher volume, which turns into much higher experience. So the company that I work for, I'm a part of DLC Affinity Mortgage Solutions. We've been consistently in the top 5 Dominion brokerages in Canada among the rankings. Last year, I think we did a business of about $1 billion. Now, when you talk about that number, and we're sending big numbers to different banks, so one, we have a lot of experience, and pooled experience is what I'm talking about. I do a certain amount of deals, but I have this entire team of 250 people. So just this morning, I had someone come up and they were looking for a specific solution. If I do not know that, I can always put it on my group and get an answer. And get referrals. So things, I think that also makes us stand out as compared to just walking in. And that is my assumption. I've seen that from experience as well. So that's one big difference between banks and mortgage agents / brokers.
And another thing I'll add to that, since you're giving so much business to the banks, you have a lot of negotiating power as well.
Always.
In terms of getting better rates, in terms of getting better qualifications. Because again, we know it's sort of a volume business as well. The more business you do,
it always is.
The higher your value. I mean, you're a more valued client for the bank or any lender at that point. And you're going to get what they call preferred rates, right?
You get
So-
preferred rate. Sorry to cut you there.
No, of
But you
course.
get preferred solutions too. You
Yeah.
would want to believe that doesn't happen.
Yeah.
But certain products only unlock after
Right.
you've hit a certain volume.
Right.
So not everyone has access to all the products
Right.
with various lenders. So you have to be, say, premium category, platinum category, or whatever,
Right.
to have access to those products. So negotiation, absolutely. But also, when you are doing so much volume with certain lenders, you know the ins and outs of the product. So I always say this, that mortgage is as much a science as it is an art.
Yeah.
Because a lot of people think mortgages is about numbers. People would call me, what's the rate? Or this is my income, how much would I qualify? But there is so much more that's going on. Because if you call me and say, okay, I make $100,000, how much would I qualify? I would never give you the number.
Yeah.
I'd always go back and say, how long have you been doing this? Are you full-time permanent?
Right.
Or are you contractual? You know, and things like those. But there have been cases where someone has come to me, declined by the bank, and we've got them approved with the very same bank with the exact same set of documents. It is just that the understanding of the product and using the right product over the wrong one.
Yeah.
Because once you send the deal saying, oh, just give me an exception. I've seen that. You know, it's almost like throwing stuff on the wall and hope it sticks.
Yeah.
But, oh, give me an exception. You didn't need an exception for that. There's a product for that.
Yeah.
And just structure it with that product, because when you tell the underwriter, give me an exception, the ball's in their court. And they're like, no, I don't think this warrants an exception.
Right.
Deal's not strong enough.
Right.
You never needed that.
Yeah.
They've come to me and I said, we'll take you to the same bank because they have a product for this. People have been shocked when the deal's been approved. And it's not happened with one bank, it's happened with multiple banks. So I guess that experience also counts for a lot.
Absolutely. Absolutely. Talk about some of the other things that you see people doing wrong or mistakes that they make.
Right. I guess the first thing definitely was walking into your bank.
Yeah.
And I'll walk into my bank. There's no harm in doing that. Do it, absolutely.
Yeah.
But have a second opinion too. The qualification can be much higher too. So that's important. The second thing that I've seen, the second mistake that people tend to make quite often, is not knowing the process of how things work. And I guess we'll go into detail a little later on into the process. But just to kind of give you a summary, I had someone recently call me. So these people had initially spoken with me, and then they said, no, we have a relative who is with the bank and they'll be doing our mortgage. And I forgot about it, and we were not in touch until this very day when they called me. And they said, I want to speak with you urgently. It's the real estate agent calling me who referred me the deal, and can you speak with them? I said, I'm here to help.
Yeah.
They didn't work with me, doesn't matter, I'm here to help.
Yeah.
So he says they're closing tomorrow and they don't have the instructions out to the lawyer yet.
24 hours before they close. Wow.
And not even 24, because it was past 5. So that day is gone. We just left with one
So
business day.
essentially on the day of.
On the day off.
Okay. That's
And these
amazing.
guys called me and they're like, we've done everything that we had to.
Yeah.
I don't know what's up.
Yeah.
I said, but there has to be some things that up.
Right.
And something's wrong.
Yeah.
And they're like, what can we do about this? I said, do you have an approval from the bank? They said, yes, we do. I said, can you send me the approval? They sent me a copy of the approval. The first page was all good. This is what they've received. Flip the page and there are conditions. So as always,
I'm assuming. Yeah.
MLS, agreement to purchase and sale, income documents, and things like this.
Right.
And I said, do you know if these conditions have been fulfilled? And they say, our banker only called us yesterday asking for documents, income documents, pay stubs. We'd sent the documents earlier, but he said that we need updated documents, which is very, very rare.
Yeah.
So how rare is it? I'll tell you. With top banks, I've been in the business 7 years, 200 deals. I've never had a bank come back and say, send me updated documents, unless it's a pre-construction where the 4 months have elapsed and you have to kind of redo the deal.
Yeah.
But in a regular deal, if you've done everything up front, they would never come back and ask for documents. Even during COVID times, they didn't. When so many people were being laid off, they still, kept to their promise saying, we've reviewed the documents, your deal's done. So them coming back for updated documents made me believe that perhaps they never sent it, and now the documents are stale, so they can't send those.
Right.
And this guy was very, very frantic, and he's yelling, he's cursing, and I get it. And I'm not taking it personally. I know he's not yelling at me, but he's very anxious.
Yeah.
And he's like, it's not possible. It's not my problem. I sent everything. It's the bank's problem that they did not fulfill the conditions.
No, but you're buying the house. It's your problem.
Exactly. And I said, no, but all of this is outstanding. And he's like, how is that possible? How can they give me an approval? They talked about something called firm approval. And they said, that's not possible. Once you have an approval letter, it's always firm. And I'll tell you one thing, never. If everything's upfront, I've had deals where everything is upfront, there'll still be one outstanding condition, that'll be signed commitment. You have to sign the approval to give them the commitment that you want to work with the bank. And if you've not signed it, I asked them, have you signed it? They haven't. So you haven't even fulfilled that basic condition. So to cut the long story short, people don't know the process. And it's important that you kind of speak with your mortgage person about that upfront as to what to expect going forward, be it pre-qualification, being pre-approval, or after the firm approval, what's going to happen. And we'll get into details of that as well. But not knowing the process is a big no-no.
And this is what I meant, a few minutes earlier when I said most people don't have the necessary knowledge, and it becomes our responsibility, or in this specific case, whosoever was at the bank, advising and guiding them. It was their responsibility to educate them about the entire process, the sequence of events, one after the other, how things will unfold, and then, what their roles and responsibilities are as consumers, as buyers at every step of the way.
Absolutely.
Right.
And keeping them educated, because I'll tell you something. I don't know how it happens on the other side of things, but on my side of things as a broker, or as a mortgage agent, most of the banks have their portals. And the portal would always tell me, this is satisfied, this is referred, and this is outstanding. It's very easy for me to reference back to it and keep my customers updated or clients updated saying, this is outstanding. And one thing that I always follow, and people get bugged with it, you've had a couple of clients where the closing was say 3 or 4 months long. I make it a point to call my clients every single week. Sometimes it's just saying, this is what's outstanding, because they may be gathering their down payments, just so they know, to keep them on their toes. Even if the deal's complete, just to find out, is the deal instructed to the lawyer? I see it's instructed. Have you spoken to your lawyer? Have the lawyer reached out to you? And things like those, just to make sure that you are on the top of what's going on. If that's not happening, I guess run and take a second opinion. Because if there's been radio silence for 2 months, that's not good news.
Chances are you're not closing. You're not closing on time, for sure.
Exactly. And what do these people do? They end up with bad mortgages. Because on the day off, what are you getting? Maybe private. So make sure it's upfront.
Even if, let's consider the best case scenario. Even if you're able to push out the closing by, let's say, a couple of weeks, the seller is not going to do that free of cost.
Absolutely not.
They're not going to be philanthropic about it. They will say, okay, you need 2 more weeks, give us $5,000.
Absolutely.
It's a cost of doing business. I mean,
100%.
You messed up, so now better pay for it.
All the time. And we see that often, right? If that happens, if an extension happens, that's what people have to do.
Yeah, absolutely. And something I want to touch upon, because again, in terms of education, I see people knowing it yet not kind of understanding it and still making mistakes, is the credit. Talk about credit. How important is it? And if, let's say, you're planning to buy in the next 3, 6, 12 months, what are some of the things that you can do to ensure that when you go to the lender or a bank for a mortgage, you're looked at favorably?
I think one of the things that is commonly known, but I'll still reiterate, is when you come into the country, have a credit. Get a credit card even if you don't want to use it.
1 or 2?
2. I would say 2. 2 each.
So if you're a couple, maybe 2 each, so 4 in total?
Yeah.
And also touch upon, and I know sorry I interjected you, but talk about how exactly to be using those credit cards to make sure that the credit grows and consistently stays up.
Correct. So, your credit score is a factor of multiple things. How new is it? How long have you had the credit? So as soon as you come in, I think the first thing you should do is get a credit card or a line of credit, any sort of credit, have 2 of them. Then the next is utilization. Make sure you're not overusing them. And sometimes when we think of overutilization, we are assuming people who are maybe debt trapped, they have a lot of debt. I've had people, includes myself when I was new, is why do I want to have multiple credit cards? I have this one card and I'm going to max it out. So when I was new to the country, I had this one credit card because I was lazy. Why would I have multiple credit cards? $2,000 balance. I was a student when I came in.
And that's more than enough, isn't it?
Exactly. I'll max it out. Every month I'll max it out. And I saw my credit took a plunge. That's when I started thinking something's wrong. So they look at utilization. And when I say utilization, again, the other confusion that people have is I have one card that's with 5,000 credit limit. I have the other one with another $5,000. I'm going to max out this one at 5. I'm not going to use the other one. My utilization is 50. Not They don't look at it like that.
Yeah.
Every single credit line should not go beyond 50% in my opinion. So that is ideal.
Right.
Everyone has a different number. Someone would say 70, someone would say 50. I'd say keep it under 50 if you could. And that's why you need to have multiple credit lines so you're not maxing out.
Right.
And if you think that you need to use more of it, just make the payment and pay it off as soon as you can.
Right.
Once it goes beyond. Because if the utilization is higher, then your credit score starts to dip as well. So one is the number of credit lines, how new it is, make use of them. What I've also seen people doing is you take credit cards and you don't use it at all.
Right.
That's not great as well. So I was like, if you get a credit card, use it. And then keep an eye on what gets reported. Sometimes we lose our eye on the ball with minor things. I've had a lot of this with phone bills. People have something that they do not like about their phone bill. Oh, I got overcharged here. And it's like a $50 overcharge. And I'm not going to pay this. You don't pay this long enough, it goes into collection. The next thing you know, for $50, your credit is ruined.
Right.
And you would not believe how many times, Shay, you think that it's a rare occurrence. How many times have I had to convince the bank that the credit's bad because of that one collection, but look at the amount, $53, $46. Don't lose your eye on the ball. I don't think you can, it's my personal opinion, I don't think you can win those games.
Yeah.
I would say if I were you and it's happened to me,
just pay, move
just
on.
pay and move on. And if you are really keen on your principles and you can't do that, pay it for now.
Yeah.
And then fight for it after. At least ensure your credit's not being impacted.
Yep.
Happens with newcomers. But the big thing definitely is, like you said, 2 each. Because I've had people say, oh, I got it, my wife didn't, or vice versa, and that doesn't work.
Right.
If you have no credit, just so you know, I cannot use your income. So you might be making $100,000, but you have no credit, I can't use your income. So work on that credit. I think those are important things to kind of focus on. Get 2 cards, make sure you're not using more than 50%, make regular usage, make regular payments, and keep it for a while.
Yeah.
That's important.
And if you think you can't stop at 50, get maybe a third one.
Yeah, absolutely.
Yeah, but keep it spread out.
Yeah.
So pro tip here. Now next what I want to touch upon, Mohit, is the down payment, because I see a lot of confusion around that as well.
Yeah.
But that's only if there's nothing more you want to share at this point as far as the mistakes are concerned.
No, I think we've covered, because we'll get to down payment, which does form a part of the mistakes that people tend to make as well.
Yes. So tell me how that works, because a lot of time I get calls from people saying, okay, I know I need a minimum of 20% for making that purchase.
Yeah.
I'm not there yet. And then you have to go into the details. Okay, you don't need 20%.
Correct.
You probably need much, much less for the kind of purchase that you're trying to make. So if we can get into, how does the down payment work? And then where can you get it from? Of course, you're working, you have a job, you have some savings.
Correct.
From the money that you're making here, great. But are there any other sources that you can perhaps explore to gather those funds together?
Right. So first, let's talk about the minimum down payment. And this is something that surprises people, like you said. But when you're buying an owner-occupied property, you don't need 20% to
and owner-occupied is when you'll buy the property and you're going to be living in
the property.
Yeah, you're not going to rent it out.
Correct. It could also be a secondary property. So you've been living in a property for a while and now you're buying something for your kids. Your kids are going to university and you're buying a property for them.
Right.
So that's fine as well.
So but any of your dependents might be living in there and it's still
correct. As long as it's not rented out,
Yeah.
it's going to be owner occupied, as in either occupied by you or occupied for, say, second home, vacation home or something like
Got
that.
it.
You can go with less than 20% down payment. So even if it's a second property, that's what people get shocked by.
Right.
They have their first property and now I'm buying a second. You still can buy with less than 20 down, as long as you're planning to occupy that property. Now, what's the minimum down payment? You need 5% minimum for the first $500,000 of property value. So let's say you're buying something for $400,000. I don't know what you get for 400 anymore, but
well, let's not go there.
Yeah, but if it was, for the sake of this example, the minimum down would be $20,000.
Right.
If it's more than 500, then it's 5% for the first 500, 10% for anything up to $1 million. As soon as you hit $1 million, you need 20% down, flat.
Right.
So if you were to buy something for $1 million, then the minimum down is $200,000. But if you're buying something for $999, then you can go with 5% for the first 500, 10% for anything additional. So another example, I think 800 is a better number.
Yeah, let's go with that.
So 5% for the first 500 is $25,000. The remaining 300 would be 10%, 30,000. That's $55,000 in total. That's your down payment. You need to set aside money for your closing cost as well.
Talk about that as well. How much would that be? Like as a ballpark.
So on the banking side, we look at 1.5%.
Okay.
So of the property value. So in the same example, if it's $800,000, it's $12,000, which is your closing cost. On top of the 55, so we need to see 67. When I tell you that I need to prove down payment, I need to prove that you have 67, not 55. But you would know, and we know that sometimes it could run into a little more than 1.5. So it's better to kind of set aside close to about 2%. Especially if you're not a first-time home buyer anymore, because you don't get that rebate, the land transfer tax rebate.
Right.
So I'd say 1.5 to 2% would be a better number for you to kind of account for.
Got it.
When you're looking at down payment. That's just the minimum down. If it's an owner-occupied property. If you're buying an investment property, then it's flat 20%. You cannot have any less than 20%. But if it's owner-occupied, which is the case with a lot of newcomers, etc., then you have less than 20% down available too. Now that's the first fun part. The second fun part is the sources of down payment, because there's not one, right? We've money saved in our checking account, fantastic, we can use that. We've money saved in our savings account, that's great as well. But you can have money saved in a lot of other places. You can have money saved in your first-time home buyer savings account, which is a great tool, by the way.
Right.
I think you can save up to $40,000, $8,000 every year. If you're buying a property and if you've not opened a first-time home buyer savings account, I'd advise you do that.
Right now.
Right now. Because when you put that $8,000 towards your FHSA, which is first-time home buyer savings account, you get a tax rebate as well of that $8,000. It's deducted from your income, which is great. So you are doing some tax planning, and that's a tool available to you as a first-time home buyer. Why not use it?
Right.
So that's one tool that I ask people to use all the time. The second one that people sometimes know about, sometimes don't, is RRSP, which is Registered Retirement Savings Plan. You can set aside money towards your RRSP. How much can you set aside money depends on how much taxes have you filed. You'll be able to see it on your tax returns as to how much are you entitled to deposit every year.
Right.
Up to $60,000 per person can be withdrawn from the RRSP as a first-time home buyer without any tax implication. So let me track back here just to make it simplify this further. I'm not a first-time home buyer anymore. I have money in RRSP. If I'm going to withdraw money from my RRSP, I'll be taxed as per my personal tax bracket. So if I were to withdraw $20,000, and if I'm in a 50% tax bracket, 50% is being deducted. Most of the times, even before that tax filing happens, the banks are going to deduct up to about 30% at the source itself. So you're withdrawing $100,000, they'll only give you 70 if you're not a first-time home buyer. But if you are a first-time home buyer, you can withdraw this money without any tax implications. So when you deposit the money like a first-time home buyer savings account, you get tax deductions because that is income deductible.
Right.
And then when you withdraw it as a first-time home buyer, you have no tax implication as long as you return the money within 15 years. And that's up to $60,000 per person. Buying as a couple, you have up to $120,000 that you can withdraw. The condition to that is that the money has to be in RRSP for 90 days before you withdraw it. So you're buying a property closing next month, you can't do it. So would it be locked? No, it wouldn't be locked. You deposit it now, you can still withdraw it, but it'll be deducted. You'll have 30% deducted from it.
Got it. And I know there's recently been a lot of confusion in terms of how much can you withdraw from RRSP.
Correct.
Because earlier the limit was about 30K, now it's been increased to 60.
Correct.
So a lot of people have been reaching out to the both of us asking, okay, is it 30? Is it 60? Like, what is it?
Yeah.
So address that for me.
It was 35, it's gone to 60 per person now. So if a couple, 120. If you're 3 people, 180. right? So that's I am wondering what 3 people would compose of, but yeah. So if you're buying with your siblings or whatever, you could do up to 180 as well. So 60 per person.
Yeah, yeah.
Without getting confused into the family dynamic, 60 per person is what it is.
So we had savings, and we're talking about the sources of where the down payment can come from. So we have the savings, which is great, the easiest of them all. We have the first-time homebuyer account. We have RRSP. Is there anything else that
you have GICs as well?
Okay.
That you can, if you have money locked in there, as long as it's liquid, you're able to withdraw it. You can withdraw the money from there. We're fine using that.
Right.
One source that not many people know about, sometimes they need it, sometimes they don't, is borrowed down payment. So there's a program available specifically for first-time home buyers.
Right.
Where, or I'd say people buying their owner-occupied property, is where they could borrow their down payment.
Okay.
Now, this is an insured product, which means that a down payment, generally for insured products, any down payment that's less than 20% is considered insured. But for this product, your down payment cannot exceed 9.99%. So it has to be between 5% and 9.99%. And a part or all of your down payment can be borrowed. Now, what you have to keep in mind is 2 things. One, whatever money you're borrowing, you're not borrowing for free.
Yeah.
So the payments for that are going to be put in your liabilities and set aside against your income. We run income ratios.
Right.
So, if you have somebody, let's say a young professional who's recently started and they're doing exceedingly well, so they have the income but not the savings, this product could come in handy.
Right.
It is available. So that was the first thing to keep in mind, that it has to work in your ratios. The second thing to keep in mind is that when you get an insured mortgage, there's a premium that's charged by the insurer. And if you want, I can get into the details, but it's a little too specific. Just keep in mind that the insurance premium is slightly higher for a borrowed product because it's a specialized product.
Right.
So they're giving you this ability to borrow funds, then they're charging you a little more premium.
Right.
This is 0.5% higher.
Yeah, nothing's for free anyway.
Yeah.
So yeah, if you're getting additional benefits and it's coming with a cost, sometimes that cost is even justified because you're getting onto that appreciation bandwagon now.
Yeah.
You're getting a foot in the door in the market. You own an asset that will start appreciating right from day one. And in GTA, we know over the last 40, even beyond 50, 70 years, we've had a 7% year-on-year average appreciation, as I said, for many, many decades now. So I think it's justified, but again, that's just my personal opinion.
Correct. And I think one thing that I really believe in is clients have to start looking at the bigger picture. When I say clients, these are home buyers. Because I've had instances where people have made decisions based on fundamentals that aren't financially prudent. To give you an example, someone's qualified for a mortgage, they want to buy a house, it's the right timing. A couple, they're pregnant, the family is growing, they want to get into a property. They don't because they were approved for a product that they thought was maybe a little more expensive than the other. To give you an example of the borrowed down payment, where they had to pay, say, 0.5% higher premium. But I think what they missed out on, and it's happened, so what they tend to miss out on is what's happening with the market. Because if it's growing, and let's say if you're talking about 7% annual appreciation, then to save the 0.5%, you are giving up on the 7% that you could have. Again, there's no guarantee. They have to speak with people like you, me, experts in the industry, and they can guide you on what we believe would happen in the near future. But if you think the market's going up and you're not going in just because, I want to save up to 20% down, or this product, I do not like this product because it's slightly more expensive, then you have to, I guess, calculate what are you saving versus what are you losing out on.
Right.
Very similar to what's happening now. So this is a cliche, I guess, we've heard this a lot, but everyone's talking about how interest rates are temporary and house prices are permanent.
As they
Brings
say.
a chuckle.
Yes. As they say, what's the adage here? Marry the rate? No. Date the rate and marry the house.
Yeah.
Right?
Yeah. That's not a cliche. That sounds better.
Yeah.
But that's exactly what it is, because people tell me the rates are very high. I'd enter the market when the rates are lower. But if we use basic economic common sense, I'm again not getting into predictions, etc. But basic economic common sense is when the rates will start to drop, we all know for a fact there's pent up demand.
Oh, absolutely.
All of these people want to buy a house
Yeah.
who've been on the sidelines,
Right.
waiting for that rate drop. When these rate drops start to come about, we've already seen one. What happens then? The common expectation is there's going to be more buyers.
Yeah.
What comes with more buyers is increase in prices, increase in competition,
Right.
and then if you were to wait that 1 year for the rates to drop, the prices may have gone up significantly by then. So your rate, which is say 4.5, may be at 3% next year, but the property which was at 500, who knows, could be at 550 next year.
Yeah.
So how much are you saving and how much are you losing at the end of it?
Yeah.
Or perhaps you could now buy a freehold townhouse, you end up buying a condominium next year. Is that something you're comfortable with? And I'm not saying it for the heck of saying it. I've seen a lot of examples where people could buy a certain property segment and then they had to downsize significantly because they kind of just waited it out and the market had just passed them by.
Right. Absolutely. And one thing I'll stress upon here is that this is not our opinion.
Correct.
This is coming from hard numbers. If we look at the last 2, 3, 4 recessions,
Correct.
we have graphs and data and statistics to prove exactly what you're saying.
Yeah.
And you know what? We'll put it in the description or wherever, whatever source you're using to listen to this podcast, or if you're watching this on YouTube, we'll put the sources there, and you can see it for yourself.
Yeah.
That this is not an opinion. This is coming from hard numbers.
Yeah.
Sorry, I had to say that there.
No, absolutely. That's important. And that was my point as well. When we talked about the borrowed down payment product and we were talking about that cost, I wanted to just make sure that people don't get hung up on just one number. And this is just one cost.
Yeah.
There was something I wanted to bring up and I was wondering whether I should or I shouldn't. And that's how much
Don't
is
be on the fence, Mohit. Just like
Exactly.
the home buyers.
But that's the point. That's how much stigma people have about B lenders.
Oh, yes.
And
yes.
I was thinking, should I even talk about it or not?
No, go
But-
for it. Go for it.
But when I discuss with people about, listen, you're not qualified with a bank. You can get a mortgage with a B lender for 1 year.
And there's a lot of negative connotation associated with just the term B lenders.
Correct.
Like debunk that for us.
And it's not even correctly used. So in the industry for us, when you say A lenders versus B lenders, I would preferably put it as prime lenders and subprime lenders. And when I say prime lenders, that includes the banks and the financial institutions. Because a lot of the times I tell them, hey, you're qualified with this lender, it's a financial institution. Oh, it's a B lender. My friend told me that you don't go with a B lender. First of all, it's not a B lender.
Yeah.
It's an A lender.
Yeah.
How could a B lender give you a better rate than the bank? So, that has to be debunked. You have to understand it's not a B lender. You say prime and subprime. When we talk about subprime, which is also called B lenders, etc., these are lenders who are more flexible. So to give you an example, you and I are self-employed. So if you were to go to the bank, you have a corporation. The bank doesn't care of what you do with the corporation. To an extent, yes, we'll get into that product as well. But they'll majorly look into what your personal income is. The subprime lenders, B lenders on the other hand, would only look at your corporation bank statements, would see what your potential of earning is, your corporation's potential of earning, and then state expenses and come up with an income which becomes more flexible, gives you higher eligibility as well. So you're not qualified with a bank, you're qualified with a B lender, and people are immediately stressed out. My first question to a lot of these people is they're not even concerned about the rate. We'll get to that. But their first concern is no B lender. And my question is, you're not giving them money. You're not setting up a savings account with them.
Yeah.
They're the ones giving you money. So where is that fear comes out?
Yeah.
If someone's got to be concerned, they're the ones they should be concerned because it's a subprime lender.
Right.
So they're lending to people who have bad credit or cannot qualify with traditional lenders. What are you concerned about?
Yeah.
They don't have an answer, but it's just this principle that we wouldn't go with a B lender because my friend said so.
Yeah.
That's the first thing. The second thing is rates. Now, alternative lenders tend to be a little more expensive than the banks. When I say a little more expensive, so today as an example, if you were to get a mortgage with 20% down payment, tentatively the best rates that we've been seeing, and no one can guarantee rate, but this is what we're seeing in the market. A bank would perhaps give you prime minus 0.80 with 20% down, 30 years amortization. You're talking about 6.15.
Yeah.
A B lender would perhaps do prime minus 30, which is 6.65. So that's 50 basis points more than the bank.
Yeah.
and then they'll charge you an upfront fee of 1 to 1.5%. So if the mortgage is $500,000, that's $5,000 to $7,500.
Right.
But when you get hung up on that number, you forget that they are letting you get a foot in the door.
Right.
And they completely ignore that. You wait that 1 year or 2 years, what happens to the market? That's the first thing. Even that's okay. You want to wait.
And one thing I'd like to add here. So your upfront cost could be, let's say, $7,500 that you're paying for as the processing fee, let's call it.
Correct.
And then, you're paying $100 extra every month.
Probably not even that based on the
Probably
mortgage, but yeah,
not
$50 to $100.
So collectively, it's less than $9,000, right?
Yeah.
But if the market, forget 7%, which is actually the true number, but even if your $500,000 property, again, many people buy way more than, something that's worth way more than 500. But even if, let's consider conservatively, your $500,000 property is now at 5% appreciation.
That's $25,000.
25,000. So
Exactly.
essentially, in the very first year of making that investment,
Yep.
you're positive like 15K. What are you even talking about at that point?
Absolutely.
Right? And add multiple years of compounded appreciation.
Yeah.
You'll not think about that $7,000, $9,000 upfront in about 2 to 3 years' time because it's minuscule at that point.
Absolutely. And I think that brings me to the point that it's important for people to come with their questions.
Right.
A lot of the people come with preconceived notions that they're not willing to share, first of all, or discuss with you. So there are times when, people would tell me, give me the max eligibility. I'd say, this is what you're eligible with the bank. As soon as I said, if you wanted more, just so you know, this is what you'll get with the B lender, they get so scared that you'd perhaps not hear from them for the next 15 days.
Right.
But why not talk about it? That's what we are here for.
Yeah.
And ask questions. And I am sure you'd see the same thing about, this neighborhood versus that neighborhood.
Yeah.
Why don't you come up with questions and interview the person? This is what I'm thinking about. Same with us as well. A lot of these people just go in, I'll walk into the bank, what's your rate? Or they'll call me.
Right.
I've had cases, Shay, you wouldn't believe, Saturday morning, just walking out of the gym. It's 10 a.m., get a phone call, don't know the number, but we answer, we are in sales, we have to answer phone calls. Hi, this is Mohit. Hey brother, what's your rate? Like, okay, first of all.
That sounds wrong.
It does.
Yeah, on so many levels.
First of all, who are you?
Yeah.
What's your name? And what rate are we talking about? So, but I think we're so fixated on that we kind of tend to forget about solution and asking, how long have you been in the business? I would love for people to ask me, what's your experience like? Or do you have experience with this product over the other?
Yeah.
You tell them, I've got an interest rate. I'll mention interest rate now. I've got the interest rate of this. Oh, this is better than the others. Do it for me. But did you even ask if I could close the deal?
Yeah.
I had a similar discussion with one of your clients. In fact, I remember that. And when he was discussing, I spoke with X, Y, and Z bank. I'm speaking with you. I said, how long was your discussion with that bank? He's like, about 10 to 15 minutes, and then we walked out. I was like, how long has our phone call been? It was almost about 60 minutes by then. And I was like, do you see the difference? Because now you're asking questions, and the reason why you are asking questions is because you believe you'll get the answers.
Yeah. Yeah.
So expertise matters, and the fact that whether you can close it or not matters as well.
Yeah.
So they should interview professionals too, all of us, be it the lawyers or the real estate agents or the mortgage agents of the world. Interview us and ask the right questions.
For sure. And I think if people really start doing it, I think that's when the more professional and the more experienced people, I believe, like you and me, will outshine.
Yeah.
Because again, I hate to say this, especially on camera, but I'll still try to mince my words and say it. There are a lot of people in the industry, more than perhaps many other industries, who are just here to make some extra money on the side.
Yeah.
And again, nothing against them, but all I'm trying to say is, if somebody is in the profession on the side just to do a couple deals a year, you can't expect them to have the same level of knowledge and expertise. They can't be sitting with the same level of data and statistics.
Yeah.
They're not, they don't have a pulse on the market.
Yeah.
They're not running the numbers every month. They're not helping 15 clients a month
Yeah.
to really know what's going on.
Absolutely.
And yeah, I'll probably end it here before I start ranting about it, because we see that in the industry every day. People getting burnt by working with the wrong people and then having a perception for the same perception for everybody who's involved in the industry. right?
I agree with you.
So, as I said, I'll stop there. Now, now, one thing when people come to me, I obviously direct them to you as step 0 to get something called pre-qualified. And again, there's some confusion with regards to what is pre-qualification versus pre-approval, right? What's the difference between the two?
Right. So pre-qualification is basically me asking you a set of questions and running your eligibility. Pre-approval is when we have reviewed your documents, packaged your deal, sent it to a lender, and they are approving it on their letterhead, saying this is a pre-approval letter for you. So that's really the difference, and these are important steps for you to know. Because as an example, when you refer somebody over to me, when I speak with them, the first call is to just understand how much would they qualify for. And it's important for them is because one, they get a sense of what their eligibility looks like, even if it's approximate, because we've not looked at your documents, etc.
Right.
But second, it also kind of gives you a sense of whether you like me as a person and a professional or not. And that's why we keep it as no obligation as possible.
Right.
Which is very different from how a lot of the other professionals work, where you walk into the branch and the next thing you know, your credit's been pulled already and there's numbers floating around. I don't do that. No credit pull. I just ask you a set of questions. I would like you to be prepared with the documents, because there are times where people say, oh yeah, I think I made about $50,000 last year. You look at the document, it's $25,000, and that changes the number. And obviously they bite my head off after that, but then it's a wrong number.
Yeah.
So when
garbage in, garbage out.
Exactly. So when I send in that first email, when let's say you introduce me to the person and I respond to that email, it's always, and you would have seen that, I would like you to be prepared with this, this and that, which is generally how much income do you make right now? What have you done in the past couple of years? How much income have you made? Is there any variable income? Your credit score, so and which you can pull very easily. There's so many apps there, I guess even on your banking app, just pull me a score. And if you have any outstanding debts, once I have all that information, 99% of the times, the pre-qualification that I run is fairly accurate. That's where the experience comes in. We know what we have to do. We kind of do a detailed discovery of, what have you done, your profile, etc. And then once that's been done, I'll send out an email saying, this is the list of documents, send them over to me. And we move over to the next step, which is a pre-approval. So people like the pre-approval stage for a couple of reasons. One, now the documents have been reviewed by me and sometimes the bank. The bank doesn't always review documents at the pre-approval stage, so that's a disclaimer. But I review them. So that's why I asked for the documents. I want to underwrite the file so I know that the information being sent over to the bank is accurate.
Second, and that's 80% of the job done, because now you have experience of working on hundreds of deals.
Exactly.
So you know exactly what the underwriter is going to be looking at,
100%.
what he's going to review, what questions you can perhaps anticipate, or preempt at that point. So,
And again, that's where skill comes in, because if there are times when I want a certain thing to be reviewed by the underwriter, say there's something about the income, say they are on probation, and I've put the income in there in the loan notes, because I know they're not reviewing documents. I'll present all the information that I want them to review before doing the pre-approval. And I'll send this to the bank that is going to review my notes. Some banks do automatic pre-approvals too, by the way, computerized. So they make no sense. But we try to send it to the banks that will review our loan notes, and sometimes, if required, might even ask for documents upfront. So self-employed people, I'm using a part of your corporation income, they might ask for documents upfront. And that's why I want to underwrite it upfront. So the first advantage is the documents have been reviewed, the bank has looked at your credit, they've approved you based on the information we shared. And the third thing is that they've locked your rate. So rate has been locked, at least you have a rate ceiling. And what I mean by that is the rates go up.
What's a rate lock? Like, talk about that a bit.
Correct. So what happens is when I send a pre-approval, all the banks have their posted rates. So the rate that you actually get is sometimes much better than the posted rate, because they'll do specials and they'll do discounts, etc. But at the time of the pre-approval, they wouldn't give you all those discounts and specials and all that, because the deal's not live yet. So when we send it in, it's approved at the posted rate. However, the kind of environment that we are in, the rate environment that we are in, so volatile, you should get a rate lock, because if the rate's actually lower, we'll get you the lower rate.
Right.
But if the rate goes up, then you at least have the ceiling locked. We've had instances in the past where, because this rate lock happens for 120 days with banks, and certain B lenders would lock it for 90 days. And subprime lenders, when I say B lenders. So all the banks and prime lenders will do it for 120 days mostly. But I've had cases where people came, say, 60 days after the pre-approval, 70 days, and the rates now, the current rates are actually 0.5% higher than what we had locked. So there's no harm in doing that. It's an extra step, but it's good. And another advantage to that is, once I pull your credit for the pre-approval, if you buy the property within 30 days and we're doing a final application, I don't have to pull your credit again. I can use the same credit.
Irrespective of which lender you're going to go to.
Correct.
Got it.
Correct. Because I can use the same credit to go to everyone who works with me.
Right. Right.
So that is an advantage as well. I do tend to tell people that if you want to get a pre-approval done, first be sure you want to buy, because first-time home buyers can be excitable. So, you've run my eligibility, I'm qualified for 900, get me a pre-approval. And my next question would be, have you seen a property yet? No, we haven't. I was like, please go see a couple of properties, because that'll give you a sense of the market.
Yeah.
That'll also give you a sense of whether you're ready to buy now. Because pre-approvals, one, are valid for 4 months only. So if you think you wouldn't be able to buy in 4 months, it's a waste of your time and effort.
Right.
The second thing is, if you're closer to time, then I can use the same credit too.
Right.
Right. So that's another factor.
Gotcha. Got it. Also, as I said at the start of the episode, we want to make it broad, but at the same time, I don't want to make it too deep, because even though we're trying to segment people in terms of having a stable full-time permanent position versus a contractual versus a small business owner, each person has a different situation.
True.
And that gets analyzed on a case-by-case basis. But talking broadly now, how does the qualification done differently for these different segments or these different sorts of first-time buyers?
Right. Look, so qualification, if you look at it simplistically, it's a very simple math. Qualification is where we run your ratios, and there are two factors that we look at: income and expenses. Now, these expenses could be current, or these expenses could be potential when you're buying a property, and I add the mortgage payments, stress-tested mortgage payments on there.
Right.
So it's that simple, right? So for me, when I look at it, I have to look at how strong your income is, very important. What kind of a property are you getting into? Property taxes, maintenance fee, and if you have any current liabilities, which could even be existing mortgage payments, or it could be any car loans, car leases, credit card payments, student loans, all of that stuff. But simplistically, it's income versus expenses, and then we run your income ratios. Now, in terms of income, how are they qualified? The simplest form of income is someone who's full-time permanent. Now, you could be full-time permanent with a salary.
Yeah.
And I use that salary as your qualifying income. Let's call it qualifying income to make it simple. If you have any variable income, I can account for that too. So as an example, my salary is $60,000, but I also earn commissions. And with commission, I made about $95,000 in 2023. I made about $85,000 in 2022. I can use the average of the last 2 years if it's higher than your base, if it's advantageous to you.
Yeah.
So we can use that as well. The second type of people who are on full-time permanent are people who are on an hourly rate. That's where it gets a little tricky, is because I want to know what's the hourly rate and how many hours are you working every week for sure. If your employer,
something that perhaps would be mentioned on the employment letter.
Exactly.
So and so is working for 45 hours a week,
Exactly.
making $90 an hour,
100%.
hypothetically speaking.
Exactly, and that's where employers can make mistakes as well, because they don't intend it to present it in a certain way, but we see it differently. Where, say, a person, as an example, I'll give you a recent example. The person works 40 hours a week, but that person has been working more hours every week with overtime. So the employer wanted to be kind. They were like, they wanted to write a good letter. So instead of saying the person works 40 hours, they said the person works an average 50 hours every week. Now that means nothing to me. Because working average 50 hours does not tell the bank how many hours are you guaranteed.
Yeah.
Now, if you had 2 years of experience, I could use your last 2 years average income, and that's fine.
Yeah.
But if you are new into the industry, just started working,
Yeah.
I cannot compute your income.
Which is a large percentage of our clientele anyway.
Exactly.
You know, we deal with a lot of investors, yes, but still a large pool is first-time buyers, people
Correct.
who are new to the country, people who are just getting started with their journeys.
Exactly.
And we will talk about that a little bit more, but please
Correct.
continue.
So in that case, what I want to know, and that is what you need to see with your employer as well. Are you guaranteed any number of hours every week?
Right.
And if they are, they should be mentioned on the letter. Because if they aren't, there is no way for me to find out.
Yeah.
Right. So that's important. So this is full-time permanent. Then comes full-time permanent and part-time positions. So let's talk about someone just doing a part-time job. If you're part-time permanent, I would use your hourly rate and minimum guaranteed hours, just like if you were full-time permanent. If you are part-time contract, so your temporary work, etc., I would need to use your 2 years average. So if you just recently started a part-time contract position, it's not helping you much because the banks don't like to see it. That's where the subprime lenders come in. But that's for later. But talking about bags, simple first-time home buyers, if it's a temporary position, we might need to see what have you done in the past. And it's not necessary that you're doing the same thing. Let's say you're working with a factory right now and you are part-time temporary. You've been working with this factory for 7 months, you're not on probation. But in the past, you were working with another factory. I can still try and use the last 2 years average income because you're more or less doing the same thing, just with a different company. That's fine. You know, that's where our skill comes in and we present it saying the person's doing the same thing. So there shouldn't be any harm in using. It's an exception, by the way. So it's not guaranteed, it's not a product, but it's an exception we get almost all the time. So that's another thing. But there's another factor with first-time home buyers where they have a full-time job and they'd be like, Mohit, can I start a part-time position too?
In addition to the full-time.
Correct. To complement my income, more the income, the better the eligibility.
Yeah.
It's a good logic,
Yeah.
but the problem is the banks are first trying to see whether you are permanent or temporary. So if you're starting a new part-time temporary position, which is mostly the case with part-time jobs, it's not helping us. Even if it's part-time permanent, they would want to see some experience. The product says 2 years, but even with exceptions, I would like, if I have to present a story, I have to see 1 year. Because here's the question that the bank asks. This guy's been working a full-time job for the last 5 years. Suddenly now he's doing the full-time and a part-time position. How would they sustain that? Going from 8 hours of work, excluding your commute, to 12 hours of work, how would the person manage that? Is that sustainable? We have no history. We may not be able to use part-time income. So that's another factor.
So it's good for generating extra income, but it might not necessarily help you with more qualification and a bigger mortgage.
Correct. And that's where planning comes in the picture. I think a lot of the clients that we work with, not everyone buys instantly. Some people come to us, I'm planning to buy soon. And that is where planning comes in. Oh, I have this part-time position. So that's where we kind of dig deep and find out the right answers and plan accordingly. So that's in terms of your full-time income. The third thing is full-time contractual. And this is very different from independent contracting. So I'm not talking about an independent contractor who's running this as a business. I'm still talking about a full-time person who's on the rolls of the company. So they're still deducting taxes, but they are not permanent, they're on a contract. Ideally speaking, 2 years of average is what we need. However, if there is mitigating factors, we can work that out. So I recently had someone who passed out from a big university, did an MBA, so a coveted university MBA, and straight got into a very big company, well-known company, full-time contract. We could use that income. We did not have 2 years of history, but there's this trend because at the end, when I said art and a science, the product does not support it. But art is where, imagine this guy's passed out an MBA from a good university, working with a massive company. So the guy should have potential to have completed an MBA from that university and to have been selected by that big company. Even if they lose their job, which is the fear that the banks have, it's not permanent, they should be able to get another job. So those are structures that we can build around stories. So that's how contract works. But if you're working with a small numbered company, full-time contract, definitely need 2-year history. So that's why we need kind of stories there. After that is self-employed people. This is where the fun starts.
And is it people like you and me you're talking about?
Yes, in a way. I would include everybody, commissioned employees if you're running it as self-employed, or even business owners, etc. you can either run it as a sole proprietor or you can have your own corporation.
Do the banks look at it differently though?
Yes.
Yeah.
So if you're a sole proprietor, on your tax returns, I need your tax returns regardless if you are a business for self-employed person. On your tax returns, if you're a sole proprietor, it'll show up under business income. So the business income category would have gross income and it'll have your net income. So my gross income for the year was $200,000. My net income for the year is $120,000. The banks will use 120. However, there are products that are available where a simple product is just gross up the income by 15%, because we know, it's been a lot of the things have been expensed out, like work from home, office expense, etc. So you made 100 as an example, net income, we can try and use 115. That's just one simple product. The other product is when we go in detail into your statement of business activity, look at all the expenses, and certain expenses can be added back, like motor vehicle expenses, working from home, so house expenses,
utility bills.
Sometimes if you add that, amortization and things like those, because people tend to kind of use all of that, and we know they can be added back to arrive at an effective income. So those are things that we can do as well. Exception basis, but products exist for that. That's for a sole proprietor.
Got it.
But if you work as a corporation,
you and me now.
Exactly, the both of us. In that case, and all of this, as you're self-employed, we're looking at 2 years history. So whatever that we're talking about is 2 years of tax returns. With self-employed, there are a couple of things we'll look at. The first thing is, how much salary did you pay yourself? Employment income. So it'll show up employment income, I can use all of that. How much dividend did you pay yourself? I can use that as well. So I'll use the average of the last 2 years. And the structure could be different. I've had cases where 2022, I paid myself an employment income of $100,000. 23, zero employment income, but $100,000 dividend. That's fine. What I'm trying to see is how much income did you generate from the corporation? It could be employment income or dividend. Once that's out of the way, because most of the times that's not enough, there are lenders who are now willing to go into your corporation returns and use a part of your corporation income. So you have net income after taxes. Some lenders banks can use 100% of that and add that to your personal income. So you have a corporation, let's say an IT contractor, made $250,000 net income, paid themselves $50,000 salary, but they have a net profit of $100,000. Now their personal income is $150,000, qualifying personal income.
Got it.
We can add that back. If you want to use any of these products, you have to have financials, company financials. T2s may not work because most of us get T2s done. Financials are more expensive, but banks trust the financials more because they're prepared by a CA, CPA, and T2s don't necessarily have to have a CPA to prepare a T2. But company financials, if you have them, we can try and add your net profit, which is a big plus. Because that $100,000 could tentatively add between $400,000 to $600,000 in mortgage amount. So that's a big jump for you when you're looking at eligibility. So that's in terms of your self-employed people.
Great. Now this was really helpful. And also now we've talked about the different categories of employment, but one thing that could include any of these people is people who are new to the country, right? So we have a lot of immigrants coming in from all across the globe. And are there any specialized products catering to the needs of just these new immigrants?
Tons of them.
Yeah?
Quite a few of them. I deal with a lot of the newcomers, you and I both.
Yes.
There are a lot of people coming into the country and they're coming in with money. So they want to buy a property and they have good jobs, etc. So there are two types of products. So we divide them into two categories. One is the insured product where the down payment is less than 20% down payment. The second one is when you have more down payment, and we'll talk about that. So let's talk about the less than 20%, because a lot of the people we deal with are in that category where they want to buy something, they have $40,000, $50,000, $60,000 saved up and they want to buy a property. So the New to Canada program applies to anybody who's been in the country for less than 5 years. But if you've been in the country for 4.5 years, I'll have to explain as to why are you still being placed under New to Canada. There has to be a very solid reason. One good reason that generally works is they landed here, they went back because they just made a landing, and now they've been in the country for the last 6 months. Then it makes sense that okay, they're still new to Canada. But
soft landing, as they call it.
Exactly. But if you came in here and you've been living here for the last 4.5 years, they'll need a very strong reasoning as to why do I still have to place you under new to Canada? Because 4.5 years is not a small amount.
Right.
But with that aside, the regulation is less than 5 years. You need to be in the country for less than 5 years. And this is since the time you landed the first time.
Yeah.
And you need to have been working a full-time position for at least 3 months for your income to be used.
Okay.
So that's the first thing. So if the question is, can I come in and instantly buy? Yes, you can if you are under a corporate transfer program. So I was working for TCS in India and now I've been moved to TCS here, and I can get a letter that states that you've been transferred under the corporate transfer program. Then the 3-month rule doesn't apply because you've effectively been working for longer than that with the same company. But if you're coming in fresh and you're starting a new job, you have to be doing that for 3 months. So that's in terms of income. It's like any other person that I'll be working with, I'll use your income the same way. But what the catch here is credit, and that is what the specialization is about as well in the product, where a lot of the people wouldn't have established credit. And when banks say established credits and insurers, what do they mean by that? Because I'll have people say, oh, I got my credit now and it's 680. Isn't that established credit? No, it isn't. They want 2 years of history for 2 credit lines. That's considered established history. And not to say you can't get a mortgage without that, but when you say, is your credit history established, that's 2 years with 2 credit lines. You came in here 2 years ago but had just 1 credit card, it's still not fully established credit. We can still work with it fairly easily, but in definition, 2 years and 2 credit lines is established.
Right.
So they can see some history.
Right.
But you don't have that as a newcomer to Canada.
Yeah.
So they're able to use alternative sources of credit. The first alternative source of credit, the easiest to use, is any Equifax or TransUnion from a foreign country. So you're coming from USA, very easy. Just pull an Equifax from USA and we'll show it to them. If you are coming from India, which I work a lot with as well, they have CIBIL. So that's a TransUnion.
Right.
We can use that too. But if you're coming from any other country which has a credit reporting system, feel free to ask me. If I don't know, I'll check with the lender.
Right.
Because again, there could be intricacies to whether they can use one credit over the other.
Right.
Sometimes there could be language issues and things like that as well with credit. But if you have foreign credit, we can use that. You have 3 months of job, you have the down payment, good to go. And we'll use the foreign credit as an alternative source of credit in Canada. If you have any liabilities on that foreign credit though, that will go in your liabilities here.
Yeah.
So keep that in mind. If you have a house, then you're not a first-time home buyer anymore.
Yeah.
So keep that in mind.
But the point I want to stress upon is, and correct me if my understanding is wrong, you don't necessarily need to have 2 years of established credit in Canada to buy.
Absolutely.
Because I know for sure we deal with so many people who've been in the country for like 5, 7, 10 months.
Right.
Honestly, the average I've seen, most people in my experience of the many people we've worked with, is like 10 to 11 months.
Absolutely.
I've seen people as soon as they're nearing the first renewal for their 12 months lease, they immediately plan to kind of buy a home now.
Correct. And to answer that question, yes, they can. So 3 months of full-time work is what we need.
Right.
And if you have foreign credit, we can use that. So you don't need to wait for 2 years.
Right.
But let's say if you did not have foreign credit and you still wanted to buy, then there are other sources of alternative credit available as well. If you're putting anything less than 10% down payment, which is between 5 and 9.99, then in that case, what the bank wants to see as alternative source of credit is 12 months of payment history of other credit lines or utility bills and rents. The easy thing to do in that case is give me 12 months of bank statements. If the rent's going out of there, and if let's say some of the utility bills are going out of there, fine. If the utility bill is not going out of there, you give me your bank statements for the rent and you give me maybe your credit card statement for your other bills, depending on how you are paying some of these things. So that's possible as well. If you're paying more than 10% down payment, so we're talking about 10 to 19.99, then in that case, all I need is 6 months of bank statements, not 12.
Okay.
So that's an important factor where you've been recently in the country, you've 7 months in the country, but you want to buy with less than 10% down. You either give me foreign credit or you may have to wait 12 months for closing, not to buy, because buying and closing is different. For closing, for me to be able to show that 12 months of history to the lender before we close.
Got it. And there are also something called the equity program.
Correct.
Right. What are they all about?
So So one category was people who are coming in, they want to buy with less than 20 down. Now the other category of people is who have a lot of down payment, but they aren't making a lot of income yet, or it's not enough for them to buy the kind of property that they want to buy. Who are well suited for this program are people who were doing exceedingly well back home, but when they come to Canada, there's a gestation period in their profession. Let me give you an example. You were a doctor back home and you were doing very well, you saved up all this money. Now you come here and you need all kinds of other licenses and go through an education process. But it's understood that you would ultimately get there and you'll make a good amount of money.
Right.
So what they do in that case is they increase your eligibility. So there are different products with all kinds of banks, but I'll explain just one product to you, which is the simplest to understand. You come up with 35% down payment. A part of the down could be gifted, but majority they want you to have your own money because that's the catch point, that you are you have liquid assets, and you show that you have 12 months of mortgage payments, tax and heating available as liquid assets in your bank account. So let's say your mortgage payment is going to be $4,000 a month, $48,000 for mortgage, $4,000 for property tax and assumption, $1,200 a year for heating. That's $54,000 on top of your 35% down.
Right.
Once that is done, they will increase your income ratios from the max, which is at 44%, to 150%.
Got it.
So now, if you look at a simple math, when you go from 44 to 150, if you were qualified for 500 property, you're going straight to 1.5.
Right.
And that works wonders for people. And one more thing to clarify, I wanted to kind of clarify that once I've explained the product, is when I said 12 months of mortgage payments, don't need 12 months of mortgage payment for the entire mortgage, because that could be big.
Right.
What you need 12 months of mortgage payments for is the difference between how much mortgage you're qualified right now, based on your current income in Canada, versus how much mortgage you're actually getting. So let's say you're qualified for 500 mortgage, but you're getting a mortgage of $1 million. You only need to show 12 months of mortgage payments for the additional $500,000.
Gotcha. Right. Right.
And then that increases your qualification. One thing to keep in mind, a lot of people ask me about this. You need to be working here in Canada full time for at least 3 months. So it's not a no questions asked product. It used to exist in the past where 35% down, 12 months of mortgage payments, tax heat, you're good to go. Not anymore. You have to have some sort of income here in Canada. Got to be working full time.
Right.
But once that's done, you're doing any kind of full time work for 3 months, then we're able to get you a large amount of mortgage qualification.
Got it. Got it. I think that's a very important point you mentioned there. Now, we've talked about first time buyers a lot. We've talked about the different ways in which, they are placed in terms of their employment.
Correct.
What we haven't touched upon yet is the investors, right? So somebody who has a primary residence, who's already sitting with, let's say, a couple of rental units as well, and now they just want to expand their portfolio. They want to go to 5, 7, 10 doors, as we call them. How are some of the products placed for these guys now?
Yeah, there are many products available for investors as well. And I think more than anything, when it comes to one, new to Canada, and second, investors, is where you need to have experience in the industry, because every lender is unique. First of all, a lot of the lenders have their own requirements on what is the maximum number of properties that you can own.
Okay.
Some people can say that they can allow a maximum of 5 properties, 1 owner occupied and 4 rental units. Some other lenders would say, I allow a maximum of 5 with me, with that lender. So you could have 5 with anyone else.
5 with 6 different banks.
Exactly. And then you don't have any mortgage with them, you still have 5 left.
Right, right.
So that's the first thing to keep in mind, because when you said they already have a couple and trying to get more, that's where this information comes into the picture. Sometimes if you have a larger portfolio, that's where subprime lenders come in the picture as well, because the banks always max out at a certain number. Most banks max out at 5. So 1 principal and 4 primary.
Right.
There are certain banks who would let you go a little higher than that, but once you have like a larger portfolio, say 9, 10, 11, I don't know if you want to go there, but that changes the dynamic altogether.
Right.
But for, I don't know, small time investors is the right word, but new investors who are buying their first or second or third investment property, it's pretty straightforward to get your mortgages done with the bank as well. There are different types of products available. The one thing to keep in mind is down payment is 20%.
Right.
So you cannot have anything less than 20% down. However, certain banks will allow a part of the down payment to be gifted. Most banks won't. Certain banks will allow, say, up to 5% or 10% of the down payment to be gifted.
Right.
Which is again an important factor to keep in mind if you're buying an investment property. Because if you are planning to get some gift from an immediate family member, then we need to select the right bank for you.
Right.
That's when again the mortgage broker versus bank discussion comes in the picture. Because you might go into your bank but they do not allow gifts.
Right.
Now you're switching to different banks because you don't know which one would do it.
Right.
Versus coming to just one person and I can tell you, no, your bank wouldn't do it. You have to go to this bank,
Right.
as an example. So,
Yeah.
that's another factor to keep in mind. But things that we look at is, what sets aside one bank from the other is how they treat your rental income. Because it's income and most people believe it's just simple. Add whatever rent I'm making, add that to my income. Doesn't work like that. There are different programs. I'm going slightly into depth into how we structure deals on the mortgage side for investment properties. But there's something called we call add back versus something we call offset. And then there are worksheets, etc. But in simple English, add back is where if you're buying an investment property, I'll add a part of the rent, sometimes 50, sometimes 60, depending on the lender, to your income, and I'll add certain expenses of that property, definitely mortgage payments, but in case property tax, maintenance fee, etc., to your liabilities, and then your ratios work accordingly. Offset is where I don't do this, but I do a calculation separately, saying, okay, I'll take 90% of your rent and deduct all the expenses. If it's a surplus, I'll add that to your income. If that's a deficit, I'll add that to your liabilities. But then there are other specialized products where you run it on a worksheet. So you put the rent, take out all the expenses. The beauty of that product is it sounds the same, but it's different. Is if you have a deficit, which is the case most of the times, if you have a deficit that doesn't get added to your liability, it's deducted from your income, which works out much better in terms of the ratios. And that is where we decide, okay, whether we want to go with this lender or that. So when someone, let's say if your client calls me and I want to buy an investment property, I already have a couple, etc. When I said that in the first 30 minutes, I would know that which bank am I placing them with. In this case, it could sometimes take longer because every bank is different. And every bank has a different worksheet too. So when I'm talking to you, now I'm running your numbers with every worksheet and saying, X bank, this is how much you qualify. Y bank, this is how much you qualify. With bank Z, this is how much you'd qualify. And then you make a decision. I recently had a deal. I just got an approval. And the client wanted to buy, they were buying a rental property, pre-construction coming up for closing in July. I ran their numbers. Their numbers were only working with one bank. But because the product is so special, the bank does not negotiate a lot on the rates. And I said, how important is the rate for you? He's like, very. I said, okay, this lender will give you this rate. If you want to move to another bank, you'll have to pay off your car loan. Do you want to do that? Is rate that important? He was like, yes, it is. He paid off his car loan. I moved him to another bank and we made it work there. So that's the discussion that we can have with them and understand what is their priority. There's no right or wrong answer. Rate could be important for you. I'm no one to judge that. But if it's important, then you'll have to do X to get that kind of rate.
Right. And I believe we've discussed some great information today. But one thing I'll say outside of all this discussion, I'm sure people will find it really informative and helpful. However, I will say that each person is different. As I always say, their personal and financial situation is different than anybody else. Don't assume, even though most of the information we're telling you today is correct to the best of our knowledge and ability, but still, don't assume anything, even when you've heard it live or on the podcast from us today. If you have any questions, if you have any doubts, confusions, you just want a second opinion or just need a sounding board, reach out specifically to my friend Mohit here, to myself, and we will help discuss your specific situation and then recommend whatever we think is the best solution or outcome for that situation.
In fact, if I could add to that, and I'm speaking about myself, but I'm sure it's the same for you, is if you have a question as a client, I want you to come and talk to us because none of us are the traditional salesperson that you think of who's going to try and push the sale on you. We've had instances where we've told people we've had common clients as well.
Yes.
Why don't you wait a few months, because
Yes.
this may not be the right time based on
Yeah.
your financial situation.
Yes.
So
and
it
we've
doesn't.
lost clients.
And we've lost clients
And we've
like
lost
that.
clients like that.
So if
Yeah.
you think you have a question and you're
Yeah.
scared of asking because you think someone's going to push a sale,
Right.
or we'll start, sending you email blasts starting tomorrow. We don't do anything of that sort.
Yeah.
We believe in the quality that we bring to the table.
Yeah.
We'll give you our answers, and then we leave it up to you to decide what you want to do next.
Absolutely. And I think since you mentioned the timing of the market, this happened a lot with us towards the end of 2021, like after October 2021 up until the first quarter of 2022, when we were asking people to wait,
Yeah.
because we could see, okay, the market is now unsustainable. The
Correct.
growth and depreciation that we're seeing cannot continue for long.
Correct.
And we were asking people to hold off for not long, maybe just a quarter.
Yeah.
And I think once people decide that they want to do something, they just go ahead and do it, irrespective of what somebody's professional opinion is. And,
Absolutely.
And yeah, I agree with that. That happens. So any last thoughts or comments that you'd like to share with the audience today?
No, I guess I keep repeating this, but I cannot emphasize enough on the importance of having the right professionals by your side. And
A power team, as we call them.
Exactly. This might sound salesy, but trust me, it's not.
Yeah.
Because if I can say it with this conviction, there has to be some content to it as well.
Yeah.
But I'm not saying just come work with me or come work with
For
Shay.
sure.
But interview us and interview other people.
Yeah.
And we encourage people to do that, because we're
Yes.
pretty confident that
Yes.
if you understand value of experience
Yeah.
and skill,
Yeah.
you would come back.
Yeah.
I don't need to try and sell you something.
For sure.
Right? But do interview people. Just don't, and even with us, just don't come by and work with that one person.
Yeah.
Try and see what the market has on offer,
Yeah.
because I cannot tell you how many people, burn their fingers and come to us at the last minute saying, oh, I shouldn't have done this, or I shouldn't have trusted that.
Right.
And if one opinion is drastically different from the other, take a third opinion.
Yeah.
I've had cases where I told someone you're qualified for 550, and the person never called me back until they said, actually I bought a property and I'm struggling now because I bought it for 650. I said, why did you? And she said, I never came back to you because someone else said, that's stupid. What 550? I can qualify you for 650. Turns out she could only qualify for 550. And now I couldn't do anything either because I said 550.
Yeah.
She got a mortgage, last minute mortgage, for at 27-30% rate including fees. And and it's painful to see first time home buyers going through that situation.
Yeah,
so if one person's quoted something, the other person's drastically different, there's no harm in asking why is it different.
Yeah.
And if they are able to explain it, well and good. If they aren't, then maybe it's fishy, and find out what's going on.
I hope we brought great value and will continue to deliver this promise of bringing great content and real estate education. I hope we gave you some points that can avoid you making some mistakes in either starting your real estate journey or along the way. Feel free to reach out anytime to myself or to Mohit, and we'll be more than happy to answer your questions. Thank you.